Alright, so we're back with another trade review. Today we're going to be going over today's trading, which is May 23rd, which is the Friday. Um, Quick disclaimer, coming into today, I did show up 10 minutes late. You can see right here, I'm marking up my chart, marking up any levels that are new or things that I need to pay attention to, but this is not super important. And I only took one trade today. One trade is all I took today. Oops. And I'm gonna go ahead and just fast forward to that. So this is the same sort of situation that happened yesterday, Thursday, May 22nd, where we proceed to take a 5 minute high, like we did here. We get our internal sweep, and then we just do not create any bearish fair value gaps to the downside. So you can see we were about to create one there, but we didn't. We closed it back in. And then if I fast forward, same thing here, right? So this is our sweep. This is our high. Here is our 15-second sweep. No gaps on this move up or on this move down. We get a pullback, and then we start to get gaps here. So now, yesterday, May 22nd, the way I traded, I really shouldn't have traded like that. Um, and yesterday was a little bit more aggressive of a move down compared to today. But I just didn't feel too confident placing any short positions anywhere because where can I comfortably put my stop? Well, the only safe high, like a high that has taken liquidity, would be this high up here. So, for example, if I were to short this 15-second gap that we created here, the only place I could really put my stop would be here. This is the only safe high. If I were to short this gap here, same thing, stop would have to be here. And it's too much risk. And that's a big thing that I'm been working on, and something I've been working on for a while, but have been implementing really good recently, is making sure that when I place a trade, I'm placing it with the expectation that I'm going to lose. So I want to make sure that I can get the best entry that I can, and I can get the best stop loss placement that I can, because the smaller you can make your risk, like the smaller the losses that you take on the trades that do lose, the easier it's going to be for those winning trades to cover your losses and to put you in profit. So, like I said, I didn't take any of these trades on the move down, obviously. Um, you can see I was just kind of looking at something. I was like, okay, like, there's a fair value gap here, 5 minute fair value gap. There's our first touch, and then here's our second sweep. And it did end up working a little bit here, but it's not my model. So fast forward a little bit, we do end up coming back up to this safe high up here. Now you can see we did create a new 5 minute buy side level, this black line here. But if you pay attention to how we react off of this 15-second sweep here, you can kind of see that we might not really be too interested in actually getting up here to this to the high day. We'll just put it at that. Now something too, that I just want to like say, when it comes to fair value gaps, volume imbalances have to be included in the gaps as well. So like a prime example is this move here. So if I let's just do this real quick, just so I can draw. So if I were to just take a screenshot, now you can kind of see the actual gap that like I marked is way bigger than a normal gap. So like a normal gap would just be this right here, right? This would be our normal gap. But something that I learned in some of his mentorships is that the volume imbalances are part of the fair value gap as well. So this is the true gap, not not this gap here. And that goes for every time frame. Because I'm sure anybody who does trade ICT, maybe like, oh wow, like it just missed the fair value gap, or you know whatnot. But if you really look at the volume imbalances on the candles that create the gap, you'll see that they actually do tap. So what brought me to this example was here. So say for whatever reason you wanted to get long at this at going up here, right? You would normally mark your gap out like this, right? And you can see after we created the gap, which was on this candle here, when this candle retraces, it doesn't make it down to this gap. But if you include the volume imbalances in the gap, then you can see, well, we actually did tap into the fair value gap here. That's just something that I want to put in the notice. I know I've been doing it a lot on my trades, haven't really discussed it, and so I just kind of want to pay attention to it. Same thing down here. Now, I can tell this is a gap because there's, this should be another candle here, but there's no wick. So this is a gap here, but you can see, say, just for example purposes, the gap's here. You can see price pulls back, doesn't tap it. But if you mark out, if you include the volume imbalances as part of your gaps, you'll see a lot more gaps get tested, and you won't, quote unquote, miss any kind of moves. I just wanted to put that out there. So either way, I have my limit to sell here. I have my stop at the high. This is one of my bigger risking trades that I've taken. You can see I'm kind of hesitant. I'm like, all right, like fuck it, like we'll go with it. We'll go with the 14-point stop, which is about $140 risk. It's gonna get real messy here in a little bit, but just while the chart looks clean, like I've always said, this is my short target. It's the prior 5-minute candle's low. So this candle right here from my entry point. So we're just gonna fast forward to when I get filled. Okay. So at the point, I thought maybe I was gonna get filled here. So this was going to be, this candle's lows was going to be my target. But since we didn't get filled on this 5-minute candle, this candle's low is now my new target. So I'm going to fast forward. You can see we're still within that candle. And then I think at the very end, yeah, so you can see we're still within this candle. And so this is still my target here. I went to the bathroom, so I was looking at it on my phone, but we're gonna come back to this here. So something that I had talked about in my the last trade review as well, is that the better entry seems to be putting my entry on the fill of the gap. Now, again, I didn't do it today because I was just worried that I wasn't going to get filled, but again, to the truth, it filled it all the way. And so I could have gone in about, I think, 10 points higher. So I would have decreased my risk 76, and then it's about 7 or 8 points higher. So I could have been risking less than $100 and made an extra $80, $90 on my trade if I would have taken it here, which doesn't seem super important, but over the long term, cutting off $70 losses, or cutting down, $70 from each loss that you take can add up, and then adding $70 to every win that you take can add up. So don't knock, getting like a better couple extra points entry, maybe 10 points, maybe 15 points better entry. Understanding efficient stop losses, understanding that you don't have to have a giant stop loss because you're scared that the market's going to take your stop loss. If you trade in a way that I'm trading, you will understand when you should be entering a position and when your stop loss is actually safe. Now, this is going to be a prime example of what a safe high is. Now, like I stated before, this move here had swept a 15-second high. Now, this is the safe high that's in the market. So price should not want to take this high again because it already has. You can see here, I was like, okay, that's it. Like, it's about to stop me out, but it doesn't. It comes back right. It comes right back down. And we proceed to do this over and over and over again. If I fast forward a little bit, you can see we are just in pure chop. I'm still in the trade, right? You can see after we got that first initial push up, we did get a nice push down. Price came back up, consolidated, and then now we're getting a giant expansion candle to the upside. This is going to be a prime example of you need to keep your emotions in complete control. Because a lot of people will be like, oh, it's over. Let me just press the X. You know, man, cost myself, I can save myself $40, right? You are not wrong until the trade hits your stop loss. And you are not to exit your trade unless it hits your target. It is that simple. When you place a trade, you need to respect your stop loss and you need to respect your target. You put your stop loss for a reason, you got your entry for a reason, and your target is at where it is for a reason. Let your plan play out. Don't let the small micro movements that happen in the market dictate your trading success. Like in the last trade review, I had said multiple times, how many times have you went to break even on a trade or cut it early because either it's moving slow or it's going against your entry, and you just cut it because you're scared of taking the loss. Why are you scared of taking the loss? Either because you don't have any confidence in your system, either because you have a completely fucked risk to reward. There are multiple things that can dictate why you cannot be confident in your trades. Again, what's happening? We came up, we swept the high again, we get a nice move in our direction, and then price is immediately pushing us in the red again. Am I closing my trade out? Absolutely not. Why? Because I'm in the trade for a reason. My stop hasn't gotten hit, so there's nothing for me to do. I am a sitting duck in the market. I have my position open, and I'm just waiting. I'm waiting for something to happen. There's no point in trying to micromanage every little movement, every little wick, every little body closure, every little speed, bid, ask, market order. It does not matter. At the end of the day, the market is here to trick us into believing inside. The market is here to trick us into believing our sick minds. Like we all have sick minds of greed, fear, and disappointment. I mean, look at this trade. Imagine I did end up closing out for a loss of $100, and then I see this move here, where I see it just start barreling towards my target. Then what? That is going to hurt you mentally more than just taking a loss. I promise it is going to hurt you more than just taking the loss. I promise it's going to hurt more than just taking the loss straight up. Cutting yourself from a winning trade, either for a small profit or for a loss, is going to hurt more than the market just proving you wrong. Because at that point, you were right, but you removed yourself from being right. So, like I said, I could have took $100 loss, and then now I'm down $100, and then now I'm like, wow, if I would have just stayed in the trade, I would have made money. I would have been done for the day. But now I'm down $100 because I took myself out of a trade, and now I'm like, okay, well, maybe I need to take another trade and try to make that $100 right back. And then now you get into one of those things where now you're trying to trade your P&L because you want to make the money back. That's not what it is. This is a business. You don't want to trade emotionally. You want to trade systematically. Every day you want to trade systematically. You want to come to the market with the same approach every fucking day. It's that simple. It's not rocket science. It's not volume profile. It's not this. It's not that. It's nothing. Find something that works and trade it to the best of your ability every fucking day. That's it. That's all you have to do. Manage your risk. Respect your stop losses. Respect your account size. Respect when you do make money. That's the biggest thing. When you make money, in the market, say I'm green. Like for example, I'm green $170, I think. Or not, sorry, $470 I'm green on the day. Most people who have solid careers don't make $400 a day. I just made $400 a day sitting at my desk, either playing the game, watching a video. Even if you make $100 a day, even if you make $200 a day, $300 a day, it's $300 at the end of the day. It might not seem like a lot because it's just numbers on the screen. It's not, real physical cash, but it is money that can be taken out and then turned into physical cash. So don't be upset with yourself if you're not making $1,000 a day, $2,000 a day, $10,000 a day. $300, $200, $150 a day can add up. Now, mind you, you're not always going to win every single day. No. For me, I have been ending green every single day since I've started the evaluation, but I know I'm going to have a losing day, and I'm just waiting for it. I can see the market conditions are kind of changing. The last 2 days have been really finicky. Like Thursday was pretty strange, and today was even worse with the chop and the consolidation and like these wicks here. Like it's just atrocious. But be grateful if you make money in the market because it's already hard enough to make money. So if you manage to be green, take it. Call it a day. Come back tomorrow. Enjoy the weekend. Do whatever. But don't feel like you need to just keep trading to try to make $1,000 or make $2,000 or you need to size up like crazy to make a bunch of money. It's unnecessary. It's not needed. But back to the charts and not so much the mental part of trading. It was a solid trade. I practiced really good mental discipline, sticking to my system, letting it go against me, not going to break even, not closing out early for a profit. I did really good about learning what the market did yesterday and trying to kind of adapt and kind of find a better way to handle it today, which I did. I didn't take any losses before I took the win. I waited patiently. I waited for a nice sweep. I waited for a nice gap, and I took my trade. I respected my target. I think this trade was a 3.1 risk to reward. So I risked $100 to make $300 in simple standpoints. But with that said, I mean that's a pretty good end to the week. I think I ended up $1,200 for the week, trading 5 micros off of a 15-second chart. Can't complain. I had about a 50% win rate, and that right there shows you how important risk reward is. I won. I think I lost 10 trades and I won 11 trades, and I ended up $1,200. That's I think it was like a 53% win rate. This is what I mean about risk to reward, meaning controlling how much you lose and making sure that your winners are bigger is so more important than being like, oh, I win 9 out of the 10 trades I place. I win 7 out of the 10 trades I place. Because as soon as you start getting into that losing streak, dude, it is going to be so hard for you to dig out of that hole. Because a win covers one loss. A loss takes one win. So you're just taking, it's just one step at a time, you know. A loss is one step backwards and a win is 2 steps forwards, or maybe 3 steps forward, or maybe 4 steps forward. But it was a good week. I'm going to enjoy my weekend, play some video games, hang out with my girlfriend, and just come back next week with the same mindset, the same trading approach, and we'll just keep the ball rolling here.